Howdy, Jacob here. Today we're looking at Churchill Downs Incorporated, and we're not talking about the hit song with Drake and Jack Harlow. We are talking about the hotel, restaurants, and leisure industry company with a 10.4 billion market cap, 15.1 billion enterprise value. They operated as a racing, online wagering, and gaming entertainment company in the U.S., founded in 1875 out of Louisville. They have been around for quite some time. Very heavy growth. I guess there's no surprise that when I looked at Penn Gaming and DraftKings and them, online gambling got very popular. And so we do see a 51% growth rate in revenue in 2021, 36% the last year. The company's over doubled over the last 3 years with increased margins on both the operating and gross margin side. So crazy that their operating margin is higher than their gross margin was 10 years ago. That is amazing. They do pay a dividend. It's very inconsequential in relation to their earnings per share. So we'll see if that's true in relation to free cash flow. I'm not concerned about that payout. Return on invested capital, okay. Even with the hefty increase in operating margin, high single digit, low double digit. Balance sheet shows 145 million cash on hand, 68 million short-term debt, 4.8 billion long-term debt. Oh, that's not what I like to see. Cash flow statement. I don't know how to read this. What is going on? So if this is truly their capital expenditures, looks like they made some devastations. Not sure I fully get that. So maybe if these are their CapEx, then they produce negative free cash for the last 2 years. And it looks like in the rolling 12, negative CapEx. So maybe these acquisitions hit their top line really well and have not helped their bottom line or free cash flow at all. I mean, looking before then, I guess it really didn't look that good either. But revenue looks great. I'm just a little skeptical about what's happening with this free cash flow. I don't like what I'm seeing here, but they do buy back a little bit of shares. Their dividend is only 29 million, so it's not very substantial, but I just don't know what they're making in money right now because the last 3 years look absolutely bonkers. And so this would be a company I definitely want to do more research on because even the numbers really aren't making any sense. So maybe I'd just do a quick deep dive to look into it, but I still only like to research companies, even look at their 10Q quarterly reports if I think it's a possible attractive buy price. So let's see if that's the case. So on the revenue growth side, I mean, they've been growing like crazy. I just don't think that that's going to keep growing like this. Their acquisition put them a heavy amount in debt. I mean, even over here, they were making max $200 million, and they're $4.7 billion in debt. So that's 20 times their free cash flow when they were producing stuff. And over here, I mean, I can't tell what's CapEx, what's not, what's others. So rolling 12 looks negative. So it looks like they just have a lot of debt, and then maybe the acquisition wasn't perfect, but I'm going to assume they slow down on the acquisition side, maybe 5%. I'm giving them a 12 on the P, price free cash flow. I'd give them a 15, but their enterprise value is so much greater than their market cap, and I don't think they're able to really minimize that differential anytime soon, especially over the next 7 years. So I do still feel comfortable with that. Their margins are pretty good. Let's give them a pretty wide range here because I don't really know what to expect. Share change. They do buy back shares. I don't know if they can afford it, but they do buy back 130 million. That's way too much. So let's just say they offset stock-based compensation. Dividend looks like in for it. Again, this was a tough company to review just based on numbers, but even with my assumptions, it says it needs to fall 73% before you get the price we're looking for here. To me, it's just, okay, even if I keep that the same and I say, hey, maybe they, grow a bunch, they're able to have these fat margins, maybe I think they deserve a 20 PE. By then, it still looks like it needs to fall 12%, and I'm making so frothy assumptions, it's insane in my perspective. And so based on my conservative assumptions, 15% return I'm looking for. It needs to fall 73%. I'm going to be waiting. I don't need to waste my time here. It's just something that's not obviously making sense to me. And so why rush into it? Either way, I hope you enjoy the video and have a great rest of your day. Thank you.